Let's see. Should I stand over here?
I'll click.
You'll click?
Yeah.
Okay. All right. So thank you for having me. Brian asked me out, and I'm happy to do it. And here I am. So my name is David Howie, and I am the CEO and founder of Tellus Title Company. And we are developing a new blockchain protocol for the real estate industry. And thank you. So basically, I'm going to give you a little bit of background about myself, and then that kind of parlays into how I came about with this concept, idea, and where we're at with the project. So, let me go ahead to the next slide. So, this didn't really come out too good, but basically, this is a homegrown project. I went to high school here locally. There's actually a logo up there at my high school, Placer High School up in Auburn. From there, I went to Sac State. I majored in business administration with a concentration in real estate and land use affairs. After that, I went into the real estate industry in 2005. I interned at Marcus & Millichap, which is a commercial real estate brokerage. Publicly traded, big company, got really good experience there. From there, I went to CoStar for a little bit, which is a national database of commercial real estate listings. There's actually an ICO competitor to CoStar. Just kind of an interesting side note, but so they're trying to solve some problems with data in the industry. However, a lot of problems that go into that. So what we've done a lot of things. Just kind of going through my history here still. So I went into real estate about 2005, then the market crashed, right? So I began to rethink my life's decisions and the career I went into, and I decided to go to grad school. So around 2010, 11, 12, I went to the University of San Francisco, and I got my master's in financial analysis. I got a really good sense of how equity markets work. A lot of my coworkers worked in equities, they worked for hedge funds and things of that nature. That was around the time that I first heard about Bitcoin, and at the time, going to school, learning about finance, the knee-jerk reaction from everybody in finance is, Bitcoin is not something that makes sense in the world of finance, at least at the time. It's getting more and more adopted now. So I kind of quickly discounted it like everyone else in grad school, and it was kind of like the butt of a lot of jokes in grad school, especially people studying finance. So I didn't really take my deep dive into blockchain and Bitcoin until much later in my career. After the market tanked, I went to work for a mortgage broker, a local mortgage brokerage shop here in Sacramento, and I've been with them for about 12 years, and I'm actually the CFO of that organization. We spun off our real estate division, which is the Sarah Real Estate. I'm still the CFO of that company, and that's been in existence since 2014. And as CFO, I realized that, as the company grows and scales, there is a lot of problems or difficulties in routing payments, and that's when I first heard about Ethereum and the whole concept of smart contracts and how we could automate payment distributions and things like that. And so my job was, and still is to this day, I work for a couple of companies, is to basically route payments, and there's no automated system to do that just yet. So I began to kind of come up with the concept of how we could do that in the real estate field. And so in 2016, my son was born, and I went on paternity leave, and I had 6 weeks to kind of take a deep dive into blockchain, and that's what I did between changing diapers and staying up all night. Mm-hmm. So you can go to the next slide. So yeah, so a little bit about me. Yeah, you can click through. So again, local company. My wife went to El Camino. My daughter graduated.
Woo, I would like to.
My daughter went to Whitney, and my two stepsons went to Lincoln High School. And we have two other little ones right there. And so I can give those two little ones a lot of credit for giving me a lot of time off from work and to learn about blockchain. And so here I am. So this was in 2016. You might recognize these guys. That is Ryan Singer. He's the guy behind Chia. And that is Jeremy Gardner. He worked on the Augur and now works kind of in the VC space of blockchain, sourcing companies and coins to back and things like that. And that's Renat. He's the CEO of Altoros. They've done a lot of interesting proof of concepts using blockchain technology, mainly Hyperledger. And this is actually one of the first Hyperledger meetups in San Francisco that I helped secure a location to. It's actually the USF building in downtown San Francisco. So I've done my fair share of going to conferences, going to meetups, trying to learn as much as I can. And that's at the Impact VC Summit. That's John Allen. He's got 20 million under management and Decrypt Capital. And that's Ken from Hashgraph. That's me. So, real estate. That's my background. And I named the company Tellus Title because Tellus is actually Latin for Earth, and I came up with a new protocol that links essentially geocoordinates with blockchain. So if you have a blockchain system, you can, if it's coded properly, or for your intended use case, you can design it so you can, well, you can do a lot of things with it, but the main thing that we can do with it is we can eliminate the need for oracles. So, I'm not sure if you guys are familiar with the concept of oracles, but that's where you have some sort of interface with the distributed ledger or the blockchain with the physical world. And so, there's a lot of challenges with doing that, but if your use case is static and already has a Cartesian coordinate system, mainly GPS coordinates, and also altitude, you can create a 3D mapping system to then geocoordinate any sort of reference point anywhere in the world. And so that is pretty much the premise behind our protocol logic, and that's what we're working on. Next slide. So we just released our white paper, and here's the abstract. I won't read it verbatim, but you guys are free to download a copy of it from our website, www.tellustitle.com/whitepaper. And if you guys have any questions, feel free to reach out. We would welcome any feedback or comments. And so right now we're basically at the early phases of developing a new blockchain. And so what that entails is a lot of labor from talented coders and engineers and money to pay these guys. So it's a challenge. It's a very ambitious project, but we are up for the challenge. So with our protocol, essentially the technology already exists today to do a highly accurate 3D rendering of the physical world. And you can do that with, there's companies that produce this equipment. It's highly accurate equipment. You can attach it to a fixed wing aircraft and scan a city and have a whole three-dimensional model rendered with just a few passes of an aircraft over a city. And what that will give you is highly accurate information. And what they do is they basically, with LiDAR, blast the surface of the Earth, and signals come back, and it creates a data-rich point cloud that can then be represented into a physical rendering of any sort of location. And the problem with that is that's super data-rich, and blockchains are not really designed to be data-intensive. So with our protocol, what we've designed is basically with just one point, you can reference any point in the world. And so you don't need a super rich data cloud to tell you exactly what you're talking about. You just need one point if you can calculate a point. And what we've done is there's a well-known mathematical principle called the centroid. And if you can define the shape of anything, you can calculate the centroid. And our hypothesis is basically that with this point in space, the centroid, if it's attached to your blockchain structure, you can then go back and search the blockchain and with geofences, and you can pull back like a chain of title, or you can pull back a bunch of transactions that have happened that are time-stamped and verified throughout the network. And once this system exists, you can create a lot of different efficiencies in the ecosystem. So for instance, my background, I'm a licensed real estate broker in the state of California, and I'm affiliated with a mortgage brokerage company. And, we subscribe to an MLS, which is basically a
Data nightmare.
huge data nightmare. And there's like 700 plus MLSs. So you have 700 centralized databases with no connectivity. And it creates a big problem for
Even within a big city like LA, they have
multiple.
a joint. I happen to know a lot about this part, so I was going to ask you if MLS was kind of part of this. This is fascinating.
Yeah.
But
Yeah.
they don't talk to one another even within a kind of a co-located group of data. They still are separate. They still maintain their database separate. It's anybody in coding would think, "Are you kidding me? How is this even possible?"
Right. And even some MLSs are for-profit companies, so they have really no interest or desire to create a community of.
Or let anybody see their data. It's
Right.
ridiculous.
They want it, you have to pay for it.
Yeah.
And everyone subscribes to it, gives them the data, and then you have to pay to access. It's crazy. So this would be a solution to the MLS problem. There's an organization called I think it's the Real Estate Standards Organization, and they're instituting standards for MLS data, and they already have latitude and longitude as two of the data fields. So we're already almost ready for our system. If they just have to add a third coordinate for your height variable, and then you can incorporate a high-rise building, or you can incorporate you name it. So you can begin to develop a system that can link all the databases that are specific to real estate with our proposal. So I can go in more detail if anyone has any more questions. We can talk more.
Yeah, any questions? All right.
So,
go ahead.
Yeah. So you're a protocol, but are you also a title company? Or are you going to be?
Good question. Okay, so my background is, I've worked in the broker world on selling real estate, and I've worked in the broker world on lending. And the missing piece to close a transaction is your title and your escrow. So it's my belief that the title industry and the escrow industry, they need to be the one to embrace blockchain, because that's where all parties come together. And so it makes the most logical sense to me that a title and or escrow company develop this technology, then offer it to the agents and the lenders that want to use this protocol. So by becoming a title company, I'm bridging that gap, essentially. And I have connections in the industry, so we can beta test this and try it out. So instead of trying to go to a title company and selling them this product, which doesn't even exist, it'd be a pretty difficult sell. So my solution is just to create a title company. So
On the opposite of that, you're going to be the most hated man in title, probably there's a lot of obsolete jobs. In blockchain, we would all agree that's why we're excited about it, because we think they're all middlemen and they're not doing anything.
Right.
But that's a super impressive move. And have you gotten any feedback thus far from any
So
strong arm?
I've gone to a lot of conferences. I'm a member of the International Blockchain Real Estate Association. I went to their first conference in 2016 in Laguna, just to kind of see who's out there, what they're working on, what they're doing. And nobody's really doing anything remotely similar to our proposal. So I kept moving forward with it. I went to their conference in New York last October, and I met with some pretty high-profile individuals. And from their perspective, what they think is going on is that the title industry is doing the kind of sit back and wait approach. You see who's going to develop the technology rather than them trying to develop it. I don't know how much truth there is to that, but that's what I've been told.
Well, I guess there's enough money in it they can spy you out later, but it's still going to be a fascinating. People are making so much money in that middle ground, and that's a really large.
It's huge.
They control so much information that really is none of their business. It's kind of bizarre that because they're middlemen with the government as well.
It's a weird business model. I mean, if you think about title insurance, is the only insurance you buy that insures against something that's happened in the past. Where usually you buy insurance against things that might happen in the future. So, and it's a pretty weird industry if you think about it, but at the same time, it's kind of a needed industry because they go in there, they insure the transaction, they do the research. So they're kind of like data aggregators to a certain degree. But yeah, I just recently, we're developing some models to kind of evaluate the potential of this idea and whatnot. And so with my background in finance, I pulled up all the 10Ks of the 5 largest title companies. That's a publicly, document each publicly traded company has to file with the SEC. And so any publicly traded company, you can look up their balance sheet, their revenue, their budget, things in the past, things that they're projecting in the future. And so it's a pretty big industry. What I found really interesting from that research is that out of all of them, they spent $0 on research and development. And Goldman Sachs released a report in 2016 that basically they did an estimate that blockchain could save the industry about $4 billion a year, and they're not doing any research on how to make that happen to pass those savings down to the consumer. It's crazy.
So do you see information on any given property today is public if you just walk down the county and get it? Do you see that being the same way if everything was on the blockchain?
Yeah.
Same.
So our vision is that at some point in the future, maybe 5-10 years from now, maybe counties would operate a node, and so when you send them a token with information to one of their wallets to pay like a recording fee, that they would either acknowledge it or send a signal back saying that they've recorded this document that's been hashed into the blockchain. Or there's a number of different ways we can. Basically, it's a distributed ledger that anyone can download a copy of. And so, if you're using it not only to transmit and track how much cryptocurrency there is on that blockchain, if you're using the metadata to share data, you can then begin to explore different ideas of efficiency. So
sure. So you see it as working primarily as something completely different.
So they're probably going to be the last people to adopt this sort of technology. There's already a bill going through the state Senate Assembly to legalize blockchain. That's a pretty big bill. So the legislation has to be in place. The network has to be in place. People have to be using it. But yeah, ultimately that would be the ideal situation where every party in the ecosystem, every party in the transaction that has to interact with each other, if they do it on chain, then that's the most perfect solution. If there's certain things that happen off chain, we could, like title companies use recording services, so we could require that the recording service that goes to the county to record documents then maybe send a signal on the blockchain saying that this package has been recorded, and then that's the last thing that needs to happen before you can disperse funds. So that would be like a a trigger for a smart contract to go ahead and distribute funds.
Would you see that far down the road, that actually eliminating the need for the county recorder?
I don't think so, because I mean,
What do they serve?
So they serve as a public body to be a repository for documents to be recorded. So,
Maybe you're doing that.
but we're doing that in sort of a digital sense. So there wouldn't be a place for someone to go. I mean, we
So?
Well, I thought it was interesting. Phil said, like, okay, so yeah, you can go down to the county and do that. And then right after you said you can go down to the county and do that, you said, like, oh, the county's going to have a node. And I'm like, you have to go down to the county to go sift through paperwork. And you're thinking, like, obviously, because we're all here, we're thinking way ahead. You're like, the county's going to have a node. The county can't even put their paperwork on the computer yet.
No, I searched a county yesterday, and it's
and each
ridiculous.
county is different, and there's like 2,000 counties.
Each
So-
county's different, but each one is worse than the other.
Yeah, I mean, I would hope that would be your end goal, to get rid of them all
Yeah.
together.
Well, if we could hopefully give them a tool to be more efficient and
Yeah.
open source so everyone could access information anywhere, that would be kind of an ideal situation.
Yeah, that does bring up a bit of a privacy. Their absolute inefficiency does actually create some privacy. You cannot go out and search if you wanted on an individual. What do they own around the world? However, that changes as soon as it's on a blockchain, and that is a bit of a privacy issue, which is why I asked about is this all, what information is public? Can you look at, every note that's been issued against a property at that point, or are you looking at putting some of that data on the fringe of the network rather
Right.
than?
Yeah, so a lot of that data is still, even if you can access it, so I work in the real estate industry, so there's a lot of tools at my disposal that aren't available to
Yeah,
the average person.
I was a realtor.
And even in, like, if I'm going through the MLS and then I go through the tax search feature and I find a deed or something I want to take a look at, I click on it, I still have to actually pay money to access that record.
Sure.
But there's still, I mean, it's not totally free and open to everybody. But let's say that's your deed, and someone wants to access it, you could then maybe come up with a way to monetize off that. So instead of the title company getting paid to provide this document.
Yeah, which is what I meant by put it on the fringes of the
Right.
network.
And so it could be totally up to you whether you want that to be revealed or remain private.
Sued, yeah.
Doug, do you have questions?
Yeah, I did. Are you building your blockchain on another platform, or are you building your own platform?
So the idea is to build a protocol layer blockchain from scratch. Most projects out there, they will probably clone an existing chain and make some modifications or tweaks or go from there. To build something from scratch is a pretty ambitious project. So we're still weighing out the pros and cons. What do we really need for a proof of concept? How much is it really going to cost to build something like this? I mean, the value is certainly there. I mean, if there's an asset class worthy of its own blockchain, I mean, real estate's it, right?
Sure.
Yeah, all the real estate in the world's worth more than all the crypto in the world. So why not harness this technology for an asset class that makes perfect sense for it?
How many people are on your team currently?
6 right now. We're working through raising the seed round.
Okay.
And so once we go through that, we'll probably make some more hires and get some traction going.
Is it public how much you're raising on the seed round, or if you told us you have to kill us?
Well, it's still being determined right now.
Okay.
So our go-to-market strategy is actually just to open up an escrow company and offering services to escrow crypto for the facilitation of the transfer of real estate. So it's kind of a baby step to where we want to go with our protocol. But in the meantime, we can charge, probably a point or so for that service because it's kind of a specialized service. And we believe that there's pent-up demand. So we believe that there's people with crypto that would like to diversify into real estate and vice versa. So facilitating that trade that's our go-to-market strategy for revenue. And if we can build a sustainable business that does that, and at the same time have basically a team of engineers developing this. That's kind of what we're thinking right now.
Cool. All right, let's give it up for David. Come today that was going to speak about trading. Unfortunately, he got sick, so that is okay because that leaves an opportunity for us to talk amongst ourselves. So, what's going on?
Just as a heads up, I apologize for being late, you guys, but dinner is served.
Oh, okay.
We have Chipotle instead of pizza because if I eat any more pizza, I will die. So I had them split up the Chipotle into smaller portions, so it's not just one giant honking burrito.
Okay.
We got barbacoa steak and chicken tacos, barbacoa steak and chicken burritos.
Cool. So let's take a little break and grab that, and then we have. So
Wait,
okay.
Brian, is Mario just going to keep the Litecoin? Is that your phone or his phone? You can't. You gotta chase that guy down.
Chase him down.
You better just ask.
I keep an eye on him.
Fiat.
I keep an eye on him.
Yes.
All right. So Mario, so does it sound good?
I think so.
Okay. And then is there anything else? So we got a newcomer in here. Can you say you?
We just did introductions.
We just did introductions. Yes.
My name is Cherie.
We're playing dice.
Hi, Cherie.
Fine, thank you.
What brings you in today?
I came in, I was in here before, when it was downtown.
Cool. Okay. And what are you here to learn? Or how advanced are you?
Somewhat advanced. I've been in the blockchain, in the Bitcoin for the last 6-7 years.
Oh, okay.
Nice.
Oh, so you've been around a while. All right.
Well, it just so happened I just got into it and I didn't know what I was doing and made some money.
Cool. Very cool. Sounds good. So, all right. So sometimes you can make money if you don't know what you're doing, but sometimes you can make money if you do know what you're doing. So, Seth, are you sure the sound is good? Are you sure my hair looks good and everything? You guys like the beard or no beard? Yeah, well, we will see. So, okay, so who here knows what a stablecoin is? Okay, so only half the room. So, I'm here to talk about the rise of the stablecoin, and a stablecoin is something that is worth a steady price. So this coin is worth $1, it'll be worth $1 tomorrow, it'll be worth $1 the day after tomorrow, give and take, that's what it'll be. And making a stable coin is very difficult. It's been kind of talked about as like the holy grail when it comes to cryptocurrency, making a stable coin. Next slide. So, why is a stable coin important, right? If there's a time-based contract, what you want is you can't be like, oh, every day I'm going to give you one coin, and then the coin's worth $4, and then $8, and then $97. You can't be moving up and down like that. So you can't really do a time-based contract, and you can't like have an employee and have them a set amount for a coin. So payments can't really be set up when it's when there's various amounts. It just makes it very cumbersome, and stable coins also allow frequent trades to happen without having to go back into fiat, which is a huge disaster, because once you go crypto, you never want to go back, right? So basically, a stable coin is like all the fun of crypto without all the stress going up and down. Well, I guess it depends on your definition of fun, how much of a wild ride you want. But it just has the good things about crypto, but then not the volatility. So there are 4 types of stablecoins. Some would say there's 3, but I qualify them as 4, right? So there are collateralized stablecoins, and the type of collateralization you can have is fiat collateralization, and the biggest example of that would be Tether. And so basically what that says is you take money, put it in a bank account, you take $400, put it in a bank account, and then there's 400 Tether. Now, does Tether really have the $400? I'll get to that in a little bit. But, so that is fiat collateralized. So it means that money is backing it up, so therefore it's worth $1. So another way that you can collateralize a stable coin is through cryptocurrency. And the biggest coin that does that is MakerDAI. And what they basically do is they basically have cryptocurrency that is the backup instead of it being money, right? And so you can have money backing up a coin to keep it stable, or you can have cryptocurrency backing up the coin to keep it stable. Another type is you can have another commodity, like silver, or pork bellies, or chairs, or pieces of my beard, like whatever people think is valuable, right? Non-collateralized, a type of stable coin, that is, there's an algorithm set up so it makes it so that when a coin reaches above or below a certain point, there's all kinds of algorithms that take place that equalize and balance the coin in a very complex process. So there you go. You got collateralized by fiat, crypto, or another commodity, and you have non-collateralized, which is done by an algorithm. All right, next slide. So each one of those has advantages and disadvantages, right? So if it's a fiat, if it's fiat collateralized, it's secure from crashes, but it's not decentralized. It's very centralized because somebody has to be watching the bank account, right? And it is collateral efficient because you're taking $1 and then you're getting one coin out of it. So with crypto collateralized, they're not secure to classes because if it's collateralized by a crypto, if the crypto market crashes, all of a sudden there's nothing behind it, and that's a problem. And so therefore you have to have, and so therefore it makes it so it's not very efficient. So basically you have to take $150 to make $100, if that makes any sense. Because the cryptocurrency is so volatile, you have to have extra amount backing it up, as opposed to just $1. But if it's crypto collateralized, it could be a very decentralized system. Now with non-collateralized, that is vulnerable to crashes, but it's also decentralized and is very collateral efficient. And commodity collateralized, it kind of depends on what the commodity is and how decentralized it is. That also depends, but it is also very collateral efficient. All right, next slide. So currently there's about 19 different cryptocurrencies that are working to put some sort of a stable coin. Like I said, it's like really hot right now with investors. That's they're trying to find the crypto stable coin. And so there's 19 different coins. I'm going to talk about a few of them. But again, these are the crypto-based ones, and these are the supply-based ones, which is algorithmically based, and then these are the non-crypto ones. The biggest one there being Tether. And next slide. So fiat collateralized coins. There's two major ones that are there, and one is ahead by far, which is Tether. It is ranked number 10 on CoinMarketCap. So there's a whole bunch of money in it. The thing is, though, there's a lot of skepticism about whether there's actually money in their accounts like they say there is. They haven't been audited by a really good firm, and there's a lot of doubt that they really have $2.6 billion in their account. So another newer coin that's trying to compete with them is called TrueUSD, and it's a lot smaller by a scale of magnitude. But both of these are backed up by the US dollar. And Tether is very popular because it's on a whole bunch of exchanges. TrueUSD isn't on as many exchanges, but it's relatively new, and it is getting more popular because of the distrust a lot of people have for Tether. Next slide. So, commodity collateralized coin. There's one called the DigiDAO, and this is backed up by gold. So they actually have bars of gold in Singapore that are sitting there, and they're actually hard assets that are there, and it has been thoroughly audited. And they charge fees of when you trade it with when you trade the coin, and then they also charge a fee if you actually want to take your gold and get it delivered to you on your doorstep. They take a 1% fee for that. And so how they do it is there's two different types of coin. There's one that's the actual coin that represents the gold, and there's another coin that represents the money that's made when the transfers happen. So that is one of the interesting things that a lot of the coins have that are trying to be stable. There's two different coins, one to balance it out and one to be stable. All right, next slide. So crypto collateralized coin, you have Maker and you have Haven. Haven's based in Australia, and Maker is a pretty popular coin. And they raised some pretty substantial amounts of money, both those, one of them through ICO and one through traditional venture capitalists. And like I said, they have two different types. Like Maker has the Maker, which is the collateral, and then they have the DAI, which is the stable coin. And so Haven has the Haven coin is the collateral, and Noman's are the stable coins. Haven is relatively new, so it doesn't have that much traction. But again, the issue with these crypto collateralized coins is in order to do anything with them, you have to have $150 worth of Ethereum, and then you get to play with $100 of their stable coin. So it's very capital inefficient. Next slide. So the algorithm-based coins, they are very complex how they work. I won't get into that because that would be a whole presentation in and of itself. These have raised huge amounts of money. USDC is the stable coin of Circle, and Basis. Those are both Ethereum on the Ethereum, and these are all relatively new, so they're not on CoinMarketCap yet. You're going to see them there shortly. The other one is Carbon. That's the smallest one. And any of you guys know Kin with Hashgraph? Some of you all do. Well, this Carbon coin is based on Hashgraph, and they recently raised $3 million. And so it's very complex how their algorithm works, but they just have very complex algorithms that tries to keep it within $1. Next slide. So the conclusion is stable coins are very important, and stable coins are really the hot thing right now with investors. All those coins have strengths and problems. I would argue there's more problems than strengths with a lot of these. I have in my weird head of mine, I have a novel idea for a stable coin. I'll probably present it to you guys in about a month from now, as it's kind of working all out. So if you want a sneak peek about that, feel free to hit me up at the Barton or at Gmail, and I'm always here at the meetings. So it is kind of a hard thing to wrap your head around, stable coins. Each one of these coins, I could have done a whole presentation just about it, but hopefully you guys kind of get what they are and kind of how they're important. And so if I went over anybody's head, or if you have any other questions, go ahead and ask me. I spent the last few weeks kind of researching for this project to kind of present it to you. And don't be shy. You guys feel free to research and do a presentation as well. Yeah.
I just have a comment, and maybe everyone here can help me. But
is it that I'm better looking than your husband? We know.
I can't say that.
She clearly showed up to see what you look like without you.
There was a rumor. So, no, here's my problem with these stable coins. I think a lot of us are investing and excited about blockchain to hedge against another potential crash or another potential downturn. So why would you buy something that's worth $1 if the dollar's potentially going to be worth less than what it's worth? I mean, I don't get it.
Great question. The answer would be to use it, right? And so, for example, if I want to have an exact contract and I have something set up, it could be set up with a specific amount of that coin. So it makes it a lot easier. So the whole reason is for usability, because the reason why the grocery store won't take crypto is because it's just so volatile. You know what I mean? And it's just like they could take it and then it could just be like way down, way up.
An instant wallet deposit. You do it the day of that you're going to go then use it to purchase something, and then you whatever is left over, then you do it at instant.
Okay. So we heard in the previous presentation how much a lot of industries are really pushing for change. They already have it all set up and it's all cushy, right? And so, particularly, the real estate industry. But with stable coins, the whole point of putting it together is to actually use them on our daily life. You know what I mean? So it's all about use. They're not about investing.
It's about liquidity.
I get it. So, again, I have a crypto wallet. I trade into Tether just so I can go to the grocery and then that's it. I give
Well-
myself a budget. That way, I'm not losing any more potential.
Well, and the other thing is, if you're just like, oh, I really think OMG coin is going to go up, so I'm going to buy a whole bunch, and then, oh, I think it's going to go down, then you buy into, Tether, or you buy into one of these other coins. And so it's just kind of to keep it steady, and so you're trading in and out of it.
Quick
Alright.
question, you said that they have two different things, the algorithm to keep it stable, and then the algorithm for the stability, the two various aspects of some of the coins.
Yes.
Are they able to use one of those to render a profit as you hold it?
Yes, yeah, and so so that is the thing about a lot of those coins, and that's one of the problems I think there is with stable coins, is that there is another coin that's like the vampire coin, that's like the growing, that's like this coin's going to moon, like the maker coin's going to moon, or the haven coin's going to moon, but that's really, I feel, taking away from the usability of their stable coin, because it's like the tax man, it's like the vampire, but that's the one that everybody can get hot about, like, oh, I get the haven coin, or I got the maker coin, because that's watching and monitoring and taxing the stable coin.
But it's inflating the value of your total holdings when it does so, correct? Even though the coins are still worth the same amount each, you end up with more of them.
Because they're separate.
Granted, but they're still separate but connected, right?
Yeah, they're separate, but they're connected.
So as this coin maintains steady value,
yes,
but the algorithm allows it to increase in value based on purchases or whatever, that increased value of the secondary vampire coin, you still own that too, right? Like you're catching that windfall.
well, you buy no. So you get one or the other. You don't have to have them together.
You can invest in both, but they're separate things.
Right.
They're not- it's-
Intuitively, I would assume that there's got to be a company that does both on purpose and gives you the benefit of one without having to risk the other.
So theoretically, with the basis coin, which is they issue bonds in order to, if there's, I don't know which way bonds goes.
Basis coin is one of the algorithmic ones. And again, you guys, this is really deep stuff, and it is very confusing, and I don't know all the answers for it. And so the questions you're asking, like, I'm still trying to wrap my head around it, but this is like really cutting edge new technology. And so the whole thing is, that's why it's like the Holy Grail, because they're trying to find it, because we want to have the usability and the stability. Not everybody's as crazy and risky as us.
Yeah, you said that you put 150 in and it's worth 100. You're losing $50 on a stable coin.
Well, it's being held. It's not, you're not spending it. You have to hold it, right?
And so for the usability as opposed to the value.
Yeah, and so it's being held in an escrow, basically.
How do you get it out if you want to get it out?
You get it out after you spend the money, or you reverse it. So you can get it out anytime you like.
At gunpoint, please.
The idea of holding more than you're using as a stable coin is that if the volatility of the underlying asset is so great that price comes down, that some of them have like an instant liquidity thing where they'll just sort of get you out and give you back your ether as the price sort of drops. But theoretically, the idea is to protect them against having the price drop too much, so that while you're holding that 100.
So the stable coin is basically
It's a self-insured.
give people the
Currency.
option that, hey, for the general public or spending or buying or whatever, it gives them the security that it's going to be stable.
Exactly.
Is that right?
Exactly.
Just through the transaction.
Huh?
And then just through the transaction. Some people use it for trading, but for the most general public, it's meant for individual transactions. Like, yeah, it's like you have your major holdings, and then you go into a stable coin, buy the coffee, and then the stable coin transaction closes, and the remainder of the difference is what you have of your original ether.
Well, and each coin is doing it different, and each one's trying to kind of find the be the standard. Right now, it's Tether, but there's a lot of skepticism if there's money behind that. So that's why a lot of coins are trying to deal with that.
So the stable coin is it's not centralized, it's decentralized.
Well, that's the thing. Some of them are, and some of them aren't. The ones that are collateralized by fiat are more centralized.
Yeah.
The ones that are collateralized by cryptocurrency are less centralized, and the ones that are done algorithmically, they're saying that those are less centralized as well. So it's very confusing, and like I said, I could have spent an entire presentation just talking about one of the coins, but I kind of wanted to give an overview to kind of just be like, here's what stable coins are, and this is kind of the hot thing right now for adoption, all right? And they're obviously not for investing, but they are for if you think the market's going to go down, right? If you get, if you wake up and like, oh my gosh, crypto market's going to crash tomorrow, you're going to want to try to get into a stable coin and hope that'll be more stable.